Hello, my friends. Jeff, Tax Rescue CPA. Today we're going to talk about a subject I love, saving taxes. That's right. I have got 10 tax loopholes for you that will show you how you can save taxes and keep more money in your pocket. Now you're thinking, hey, Jeff, I thought tax loopholes were for the rich. No, my friend, I'm going to show you 10 loopholes that you can use, whether you're a small business owner, real estate investor, or even an average taxpayer. All right? These aren't tricks and they aren't shady. These aren't schemes. These are legal strategies that are defined in the tax code that you can utilize to save money. We're going to talk about everything from capital gains harvesting to home office deductions. So make sure you stick around through the whole video. But before we get started, if you haven't already, click the subscribe button and ring that bell so you don't miss out on any future tax saving tips. So let's start with number 10, capital gains harvesting. Now here's what it is. If you are in the 0% tax bracket, and I've got other videos that talk about how to make sure you are and when to know when you are in the 0% tax bracket. If you are, for capital gains, you can sell appreciated assets, right? Think that Microsoft stock that you bought back in 2000. You can sell that, pay zero tax, and then immediately rebuy the stock at its and essentially resetting your cost basis. Now, there's income limits for this for the 0% rate. And so talking about 2024, if you're single, the limit is $47,025. All right, married, we're going to double that, $94,050. So this is really comes in handy for retirees, early retirees, or anyone having a low income year, in between jobs, such and such. Maybe you're collecting unemployment that year, but you have appreciated assets in your portfolio. Consider selling them, harvesting that gain, and paying no taxes. Okay, number 9. We're talking about S-Corp payroll splitting. This is one of my favorites, okay? And this one is for a small business owner who is operating as an S-Corp. And if you're making money, just as a side note, if you're making money in your small business, we're talking 70, 80,000, somewhere in that range, I implore you to seriously consider switching to an S-Corp. But let's assume you are an S-Corp. You're going to split your income between a reasonable salary, which is subject to payroll taxes, think Social Security, Medicare. You're going to split it between that and distributions. Now, here's the key. The distributions aren't subject to self-employment, Social Security, Medicare taxes. So you're going to save 15.3% for every dollar you shift from payroll to distributions. Now, you have to keep in mind administrative issues with this structure. You have got to run payroll. You have got to keep a good set of books so that you can then report your S corporation activity on Form 1120S. And this form requires a higher level of reporting than you would normally on a Schedule C. So keep in mind that requirement, but once you get to that $60,000, $70,000, $80,000 level of income, you'll find that the savings more than eclipse the cost of running and managing the S corporation. Ask me how I know. Okay. But moving on, number 8, Section 179 and bonus depreciation. Okay, this is one you hear about all the time. You can write off the cost of equipment and vehicle purchases, software, these kinds of things in the year they were purchased. This is great. There are limits on this. The limits are relatively huge. We're talking over $1 million on Section 179, and the bonus level right now is at 60%. It fluctuates somewhat. One thing to keep in mind is on vehicles, if you're looking at vehicles that are over 6,000 pounds, think about a big SUV. These can be written off in a business, SUVs, trucks, these kind of things, vans. One shot right in the first year, you can write it all off. So this is great for, you got tradespeople, delivery people, anyone that's upgrading tools, vehicles, equipment, this kind of stuff in their business. Number 7, depreciation on rental properties. Okay, this is key. You can deduct a portion of the property's value each year by depreciating it. And you can do this even while it's appreciating. So you've got an asset, a real estate asset that's going up in value, but you can deduct part of it like it's an expense, like it's depreciating. This is great. Okay, this is spread out over years. If it's residential, it's going to be 27 and a half years. And if it's commercial, you're looking at spreading this out over 39 years. You can also use cost segregation to pull out costs that aren't specifically real estate, they're personal property, and you can deduct them even sooner, quicker, and more aggressively. This is perfect for real estate investors that are looking to shelter cash flow. Number 6, real estate, wait for it, professional status. So if you qualify, and this is the trick, is to qualify, then your rental losses can offset your ordinary income, okay? Like your wages or business income. You must spend 750 hours engaged in, or more than half of your work time, engaged in real estate type activity. This can be a huge tax savings by creating paper losses from the depreciation, which becomes that much more powerful on your tax return. Okay, so this is perfect where you've got a situation where you've got a married couple and one of the spouses is engaged in full-time real estate activity. Okay, number 5, and this one's fun. I like this one. Hire your kids. Okay, if you have a small business, you can pay your children a fair wage for legitimate work in your business, and you deduct the wages. This reduces your income, and usually in this scenario, it's going to reduce your self-employment tax. So the kids, on the other hand, can take this income, and currently they can basically pay no taxes on $14,600 of these wages. This is the standard deduction the child can take. And this won't affect at all any sort of child tax credit or anything on your side. That income that they earn from the wages you pay them, they will pay no taxes on it. So this is great because then you can fund, you can take that money and you can fund Roth IRA accounts for them, and they can start to build tax-free savings from, you can put the money into a tax-free account that they didn't pay taxes on. It's a beautiful way to double dip the whole system and set them up for financial success in the future. So this is great for sole proprietorships and family-run businesses. Okay, we're at number 4. And this one is great, Home Office Deduction. And this thing is just blown up recently because why? Well, everyone's working from home. Right? So this used to have an air of kind of, on the tax code, a kind of shadiness because people just didn't work from home. But now they do. And it's taken away that stigma and that concern about audit, getting pulled for an audit because you have a home office deduction. No more. What this is you deduct part of your home expenses. Basically all of your home expenses. Think utility, mortgage interest, internet, insurance, repairs and maintenance, right? You got lawn service, okay? These kinds of things, they wrap all up into this deduction. The key is you have to use the space in the home office regularly and exclusively in order to be deductible. There is also a simplified method where you don't even have to keep track of your expenses. You just basically check a box and take the deduction. This deduction may also reduce your capital gains tax when you sell the home if you do it right, okay? This is great for remote workers, consultants, freelancers, these kind of things. Anybody who doesn't have a traditional home office that they're using for the business and rather they're running it from their home. Okay, number 3, the backdoor Roth IRA. See, this is a situation that's great for high income earners that otherwise are maxed out or limited to their being able to contribute to a Roth IRA. You can still, what you do is you can still contribute to a Roth IRA by first contributing to a non-deductible traditional IRA, that's a tongue twister, and then converting it. Okay, now you need to be cautious about the pro rata rule on this. And this basically causes unintended tax consequences if you have other pre-tax IRAs. Okay, all this to say, this one's fairly complicated. It's a great strategy, but make sure you do it right. And this one's got that little asterisk at the end, as all of these do to some level, that says consult your tax professional before you jump into these, especially this one's. Okay, but keep in mind the Roth IRAs are great because you end up, you can just squirrel that money away and there's no required minimum distributions as you move on through life. Number two, we're getting there. Number two, health reimbursement accounts, HRAs. Business owners, okay, business owners can reimburse medical expenses tax-free for themselves and their employees. So this is a great trick where, and trick may be too strong of a word, but you hire your spouse and you offer a health plan. And then you cover the whole family's medical bills through, by paying for them through that plan. And then small business owners can deduct and reduce their taxable income using the deduction of the medical expenses through the health reimbursement arrangement. Okay, that brings us to number one. What is this, Jeff? What have we been waiting for? The Augusta rule. Golf, anyone? Now, what this is you can rent out your home for up to 14 days per year. Okay? And pay zero tax. Zero tax on the income, even if you rent it to your own business. Where did this come from? Well, this came from in Georgia, where wealthy homeowners around the golf course wanted to rent their house, or did rent their house, for folks that came for the golf tournament. And this excluded that rental income from being taxable to them. That's why it's called the Augusta rule. Okay, make sure you document whatever use you're using your home for, whether you're having a business meeting. Use a fair rental market rent price based on other properties in your area, and then you can deduct the expense of renting your own home in your business, and you don't have to claim the income personally. That is a beautiful thing. So those are our 10 tax loopholes for today. And remember, these strategies aren't loopholes in the sense of something shady and underhanded. These are intentional sections in the tax code that are designed for specific uses with proper documentation to save you taxes, whether you're a business owner, an investor, or just an average taxpayer. Know that they exist. That's the key, and that's why I'm making this video, is so that you know. A lot of people don't know about these, and make sure you use them correctly. These are things you have to do proactively. These are things you can't do after the fact. You can't get to your tax return, we're in April, and you're like, well, how can I save taxes? These are things you have to use proactively and plan ahead. Whether you're a high earner, small business owner, or you're just tired of paying too much in taxes. Okay, don't forget to like and subscribe. Who's saving you taxes?